subscribe to our YouTube channel. If you're just joining us, this is Rebecca Michael from 2545 Business Consulting. Today we're going to be talking about investments. We're going to look at what is an investment, what makes up an investment, what are the points you should consider before investing. And if you're investing, let's say you want to become an entrepreneur or you're investing in a small business, what are the key things that you should consider before starting up that business or becoming that entrepreneur? If you've not subscribed to our YouTube channel, please don't forget to hit the subscribe button. Here with me is Mr. Mazu Collins, who is a finance professional and a business consultant here at 2545 Business Consulting. You're welcome, Mr. Mazu Collins.
Thank you for having me today, Rebecca.
So, Mr. Mazu Collins, can you please explain to our viewers what investment is all about? Because normally, to a layman, I would say, when you hear about investment, you're only thinking of using your money to get more money. Can you explain what this investment concept is all about?
Definitely, Rebecca. So in essence, investments in very simple terms would entail a situation where one puts in resources, say for instance, $1 million francs CFA in terms of resources in a venture, and one expects that this will result in a value that is bigger than the 1 million. So you put in $1 million francs CFA in an investment or in a venture, and then some time passes and you expect that you're going to receive 1 million plus. So basically investments are characterized by five key things. The first one is the fact that it entails sacrifice. You've got 1 million which you could have used for something else, but then this investment or this venture requires you to put in this 1 million and wait for a period of time. The next point about investments is the fact that investments are risky. You could put the 1 million now, and after say 6 months or 1 year, the 1 million disappears. If there's a loss, then it means that investment was a failure. Then of course, there's a concept of return on investment, which I've already said. The fact that you expect more than 1 million explains the concept of returns. So you put in 1 million, take for instance, some of these banks and the microfinance institutions in our country would always expect you to maybe invest, say, 1 or 2 million in what they call a term deposit. So they'll tell you, put in 1 million today, and in 12 months you're going to get 1 million, say 1,100,000. So in essence, that 100,000 is the return on that investment. So you get back the 1 million, and you get something on top of the 1 million, which is the return on the investment. Another item also is the fact that some investments are long-term or short-term. Now, if you're constructing a house and you want to put this house on rental, that is a typical example of a long-term investment. It means that you've got, say, 20 million now. Instead of using 20 million to buy cars or buy some other things, you decide to build a house. So you've put in that 20 million in a house, you've made a sacrifice. And what you expect to receive over a period of time in terms of a return would be the rentals. So that house, that 20 million will come back probably only in 10 years or 20 years time with a return. So that's an example of a long-term investment. Contrary to a long-term investment, you got what we call a short-term investment. A typical example would be what I mentioned earlier, where you could put your money in, say, in a bank, or some of us have what we call jambi houses, where you put in savings, and in 6 months' time, the savings, the money is given back to you with interest, and that is the return. And then finally, investments have to do with control or non-control. So in the case where you put in your money in a bank, you realize that you don't control that investment. You've put in the money and you carry on your normal activities. Then the bank gives you that interest or return in 6 months. But think of a case where you had to invest in a poultry business where you run the business yourself. You realize that it's an investment where you put in money, where you put in resources, and you are expected to actually manage, run the business. So it means you have to buy the chicks, you have to buy the feed, and do everything you have to do to ensure that the chicks grow into chicken that you're going to sell for a return. Generally, investments that you have control over, are more risky than investments, I mentioned in the case where you've put in money at the bank, the risk has been transferred to the bank. And then again, there's a concept of risk and return. So the higher the risk, the higher the returns. The lower the risk, the lower the returns. If you put money in the bank, the risk is very, very, very low. The money will come back eventually, but then the return is always going to be very small. So most of the times we see you put your money in the microfinance, at the end of the year they give you like 3% or 5% interest for the whole year. But if you have to take that same money and invest in a Porsche, so that you could actually make 50% or you could lose out on it.
Thank you so much for that wonderful explanation. We've seen that investment entails sacrificing present consumption for future benefits. In our economy, we live in a capitalist world where investment, I would say, is the backbone of our economy, because when you invest in the economy, you increase the circulation of money, you create more jobs for those that are unemployed. So coming back to you, Mr. Mazu, who are those that invest, or how do we call those that carry out this process of investment?
Yes, Isabella, those who get involved in or with investments are referred to as investors. And there are, I would say, three main types of investors that exist. On the far end, you've got those that we refer to as adverse investors. That is, people who are very scared to take risk. People who they don't want anything that might not go well. And then on the other side, you've got those that we refer to as risk tolerant. It means there are people that are actually able to sacrifice huge sums of money, and they are prepared, for a huge loss as well. So it means they're prepared for a huge gain. Then you've got those who are in the middle that we refer to as medium risk takers. So in essence, yes, they are investors who want to take a risk, but at the same time, they don't want to take too much risk. And then so it means they're a little bit afraid. At the same time, they want to take a risk. So you've got those three main types. That's in terms of theoretical knowledge around investors. But I would also like to add one more group in our country, Cameroon. You've got those I refer to as copycat investors. And in our business, in our experience that we've had over the few years of operations, we understand that many people invest in a venture because they've seen another person doing it. Not necessarily because they've taken the time to assess the investment and ensure that it's what they actually like to do and what they actually is going to be profitable for them.
So, having looked at what an investment is, the types of investors that exist, and knowing that investment is a backbone of the economy, what's your advice? What can you say to the potential investors that we have out there?
Thank you very much, Isabella. So, in essence, I want to talk about three main points in terms of advice to potential investors. And I think the very first one is the fact that as a potential investor, you need to know yourself. I'll just give a simple example. If you know that a loss of 1 million could take you to the hospital, or could give you a heart attack, as we always say, then it means you're a risk-adverse investor. It means that when deciding on what to invest in, you'll be looking for things that are less risky. So I think that's the first advice that I'm going to give to potential investors. The second advice is to be able to know your environment as well. They say there is knowledge, there's power in knowledge, or knowledge is power. So if you understand your environment, it means that you'll be able to identify profitable opportunities or investments easily than somebody who does not know their environment. So it's very crucial that you understand the laws in your country, you understand the opportunities that are available, you understand the incentives, and basically you are conscious of your environment. Once you're conscious of your environment, then you are able to be a smarter investor. The third aspect, which is now, of course, very, very crucial, is the issue of appraisal. You need to be able to kind of walk through your investment before you get into the investment. So walk through here simply means that you ask yourself a key question. How sure am I that this investment is going to be profitable? So we'll talk about investment appraisal simply means that you kind of estimate or do a future estimate of what the cost will be for that investment, what the revenues will be for that investment, and find out if there's going to be a profit, or like I said earlier, if there's going to be a comfortable return on your investment. Of course, this is now a bit technical for those of you potential investors who don't have maybe financial and accounting skills. This is why it's important that for investments, especially heavy investments, you should seek the counsel of an expert. An expert in this case will mean an accountant or a financial analyst. And of course, we live in an economy where sometimes we don't plan before we do things. I mentioned the issue of a copycat investor earlier. A lot of those who do investments because of seeing their friend or family doing the investments, they just assume that the investment is profitable because they see their brother selling, or they see their friend or their neighbor selling, and then they think it's profitable and then they jump into this investment. It's very crucial that we do an appraisal. You must have heard about the term called the term business plan. A business plan basically is the product of that appraisal. So once you've done a proper appraisal, you come up with a document that is almost like a roadmap for your investment. So a business plan is like a guidance to prevent the losses. It's almost like we'd say a risk management tool. So you know yourself. You've invested in getting the right knowledge. You know that it's going to be a good investment or there's an opportunity. The last step now is for you to be very sure that this investment is profitable. So the business plan kind of crowns that to say, listen, it gives you like a roadmap or what is going to be, who are your customers, the market, the strategy you're going to use. And then of course, within that business plan, you're going to have what we call a financial forecast. And most of the times, it's something that's a long-term perspective. So it's about for 3 to 5 years. So at least you get some comfort regarding that investment before you actually go and put those resources into the investment. Remember we said that the investment would entail you sacrificing. So before you make that sacrifice, at least you have to have some sort of evidence to rely on. What we refer in life as you look before you leap, in essence.
Thank you very much for that wonderful advice, which is all about first you need to know yourself, know your risk appetite, and second you need to know your environment. Talking about knowing your environment, yesterday I met with a friend who was telling me about this cooperative that they've set up. Actually, it's our environment, and you can actually invest in that cooperative by buying a share. Of course, you're never going to know about this kind of investment if you don't have an idea, if you don't have the knowledge about your environment. And the third one is about appraising the investment. So, thank you so much, Mr. Matthew Collins, for being on today's episode.
Thank you very much, Dilabella, for having me. It was a pleasure.
Thank you so much for joining us on today's video where we've looked at what an investment is, the types of investments we have, and we've also received advice on what to consider before investing. So what is that big business you have in mind? What's that project you look forward to investing in? 2545 Business Consulting can help you, can support you realize that project. If you've not followed us on our social media platforms, please don't forget to check the link in the description box. See you in our next video where we're going to walk you through the process of writing out the business plan. If you've not subscribed, don't forget to hit the subscribe button. Thank you.